G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I've called the Dream Team back in again. The feedback from our first Q&A broker episode was awesome. We got some really good feedback. The downloads were showing some awesome engagement. So we're going to make this a regular occurrence. And what we do is unpack a little bit of what's going on at Atelier Wealth HQ, some of the frequently asked questions that we're getting as well. And hopefully if you have someone else has had that question and maybe something that's crossed your mind as well. G'day team, how we doing?
Great. Thanks, Aaron.
Thanks, Bernie.
Good, thank you, Aaron.
Yeah, good, thanks. Thanks for having us back.
Thanks, gang. Appreciate it. First question, first cap off the ranks is lender's mortgage insurance. Pretty divisive. I'd say that, it's something that divides a lot of borrowers, which is, a whole Scotty Pape thing. You need to get a 20% deposit. We call BS on that. You do not need a 20% deposit to get into the market at all. So if we talk about lender's mortgage insurance, there is a sweet spot that we commonly know that as. Damien, you're probably the numbers man here. Do you want to share a little bit more about what you see from a lender's mortgage insurance perspective?
Sure thing. Yeah, lender's mortgage insurance, it's one of those, it is a bit divisive for whatever reason, but it really shouldn't be. It's just a tool to help you get into the market sooner rather than later. If you don't have a 20% deposit, generally you will need to pay lender's mortgage insurance. And the deposit that the minimum deposit that you need, it will depend on the type of property and the bank that you go for. So with an investment property, typically we find that the sweet spot for a deposit is 12%. That allows us to then add the LMI to the loan and cap the total loan at a 90% LVR. For an owner-occupied property, banks will typically go a little bit higher and allow you to borrow up to 95%, including LMI. The sweet spot there is probably like an 8% deposit with LMI added on top to cap it at 95%. Now, there's obviously caveats all through this. There's two big banks now that go up to 95% on investment properties with LMI. There are some lenders that don't go above 90 even for owner-occupied properties. So it does change depending on the lender, depending on the property. But yeah, I don't know why there's such a big hate towards LMI. I think it's just a tool that we can use. And if you don't have access to a guarantor or a 20% deposit, it's the cost of doing business, but what's the cost of waiting and sitting out of the market? It's probably a lot bigger.
Yeah, I'll tell you the exact cost because I got these numbers the other day. So I'm going to whip around and explain to everyone the true cost of waiting according to Jay Pace. So if you checked out Jay Pace's episode last time, he kind of ran through these numbers, which were astronomical. He's just sent me through an update last week. So shout out to Jay Pace for this one. The numbers leading the pack, I want to go to everyone. Who do you think is leading the pack for capital growth at the moment?
In terms of state?
State? City?
I'll go WA.
Nate?
Yeah, Perth.
Danny?
Brisbane, Queensland.
Right. So the median increase week on week is $2,900 in Perth, $2,500 in Brizzy, $2,000 in Adelaide, $1,900 in Sydney, and Melbourne is $400 a week. And that's interesting, right? Like we're looking at such a disparity with the other cities compared to Melbourne. I'll be very open. We've seen a few buyers agents start to buy in Melbourne as well. And as I read an article, Stuart, I can't remember his last name, but he's Pro Solution, again, talking about all the reasons why Melbourne's kind of stacking the deck a little bit more from an investor perspective. But there's also that great video that did the rounds with all those new taxes that are coming out for investors out of Melbourne. So something else to bear in mind. Bernie, I know you've done a lot of 90% no LMIs. For those that don't really know, who qualifies for 90% no mortgage insurance?
Yeah, so a lot of professions actually, and it's something that we love to talk about with our professional clients. So starting off first with medicos, so think your banks, even some RNs can get LMI waivers. Then you look at your professionals such as accountants, solicitors. With some banks, they also qualify. Nate, I'm sure you can add some to the list as well.
Yeah, so on top of medical and accountants, so we can look at legal professionals as well. So some of the banks will have income caps as well, just to keep note. So for example, 120K with a particular bank you'll need to earn over to be eligible for the legal professionals. Now, nurses also with one bank who can now access LMI waivers earning over 90K a year, which is a new policy, which is great because not a lot of nurses have had access to LMI waivers in the past.
And just on that, just to confirm, it's registered nurses that are eligible. So you do need to have that qualification. But yeah, I think with the LMI waiver, if you qualify, taking advantage of it, it's just one of those little extra bonuses you get for getting yourself into that type of qualification. And it can go such a long way. We see when people have access to these LMI waivers, what they can do with their portfolio is incredible, because you can take the need for a 20% deposit or a 12% deposit and paying LMI to just straight 10. No LMI, rates at 80%. Lower rate means more borrowing. No LMI really stretch out your equity. If you're in an acquisition phase, you can really buy a lot really quickly. So if you think you might be eligible, reach out, because there is a lot you can do.
Yeah, I agree. Even another one that doesn't get talked a lot is bank employees.
Oh, yeah.
All right, it's another one that I'm surprised at how many bank employees we speak to that don't even know that they're eligible for it. So if you work for a major financial institution, double check. And sometimes now they've opened up to brokers to do that, because traditionally we couldn't do it, right? They wouldn't let us do it, but now we can. That's another one. Another one is paying LMI monthly. Now, there's one lender that we know of that does it well. So again, if you're thinking of buying, I'm going to buy this property, it's in a really good growth phase, I'm going to pay LMI monthly to the point this property increases, I get it revalued. Awesome. You haven't had to suck up that huge LMI fee. Again, if that's putting you off, there's a way around it. If that's putting you off as well, then potentially look at 85% no LMI, right? The guys are not in their head. 85% means that we're getting to the market with a 15% deposit. Yes, the rate might be slightly higher. Yeah, we know that. Yeah. But on top of that, again, you don't have to pay the high LMI fees. You don't have to worry about refinancing. You can internally refinance and get a revaluation done with there's two banks that we know of at 85%. So the small higher rate might just be a premium for a little while until you get that property revalued. Yeah. Any other thoughts from you guys?
Probably just a couple of occupations I forgot to mention, which include like pharmacists, even dentists, any of those physios, any of those medical professions. So not only just doctors or RNs, but a lot of occupations.
Banks love them.
They love you. They love you. We love you.
Yeah, and even just adding on to that, here's one that I found out just recently. I had a client. She was a solicitor, so she had a practicing certificate in New South Wales. She hated law, so she wanted to quit, but she wanted to get the LMI waiver. ANZ confirmed with me that if she changed jobs and went into a role that wasn't in the legal space, they can still include her with the LMI waiver because she has a practicing certificate that's valid. So you don't even need to be working within that role. With some lenders, you can just have your qualification. So that really helps people who, maybe had that qualification but don't want to go through with it.
Great. And now this question about, on that point, lender's mortgage insurance. If I'm an investor, should I pay lender's mortgage insurance for an investment property?
Yeah, thanks. This is one question that comes up pretty regularly for us. And I'd say, why wouldn't you? If it gets you into the market, and again, we see these numbers here that, that growth week on week, waiting to save for a 20% deposit sounds mad. You pay the mortgage insurance, you get into the market quicker. The property prices are increasing far, far higher than what your ability to save is. That's one. What's LMI, guys? Like 2%?
Yeah.
Right?
Yeah.
2%. How many times have we got a client to settlement and the property's generally increased in value? So by the time they've gone to settle, I'm like, geez, mate, you've literally made that 2% back in that gain, particularly where some clients are buying those really fast growing markets. So I think, again, for investors, if you want to scale, there are some traditional norms that you have to challenge. And one is mortgage insurance. That's a big one. The other one is what we've had for a number of younger first-time investors that are moving down that rent-investor model, or maybe they've been able to move back in with their parents, and the parents are being, obviously the bank of mum and dad being super, super generous, is a guarantor loan to get into the first or second investment property. So we've done this, and Nate's nodding because he's helped me structure these deals, which is we're doing 2 guarantor loans to buy 2 investment properties, getting into the market, no money down. So we've got 2 properties, the cash can sit in the offset accounts. So we've now been able to sell from 0 to 2 very quickly. And they're going, I didn't even know this is a possibility, right, Nate? You're nodding your head, mate.
Yeah, and I know this because I'm currently in the process of doing this myself. Yeah, it's you use the equity in your parents' property, generally your parents' property to allow you to get into the market. It's as simple as that. Now, there are caps on your parents' property. If that has a loan on it, you can only go with certain banks up to 70% of their value. So their loan plus your new loans. But yeah, what Aaron said, just allowing you to keep access to your cash, parking it in the offset account rather than, putting it into a property that you may sell in the future, keeping access to that cash and getting cash flows through your offset account.
Cool, thanks very much. One thing that's probably surprised us is the turnaround times. Like if you're listening to the media, you'd be thinking that hardly anyone's buying. This is a terrible time to buy. Rates are super high. What yields are investors getting? Right now, Google search terms are showing searching for investment properties are higher than what they were in the peak of COVID. I just can't get my head around that. And if you're listening to the media going, this is a terrible time to be buying or investing, actually knows the case. One of the lenders that we've got that specialize in investors in terms of borrowing capacity, what are they sitting at, guys? Like 15 business days? But the boys are nodding. It's crazy. And then you look at other lenders that, particularly in the, straightforward deals, your major banks, their turnaround times are pretty normal, right, guys? I mean, Damien, you're right at the coalface when it comes to turnaround times. What are you seeing at the moment?
Yeah, so definitely where lenders, where their potential calculations on how they work and how much you can borrow, if they're leaning on the more lenient side, as in they can give you more borrowing, they're tending to blow out in their turnaround times. And just like Aaron said, everyone's searching, how do I buy an investment property? Rates are high. People are thinking, well, that's counterintuitive. Well, when rates are high, borrowing's low. So where do you have to go? To a lender that has a higher borrowing power. So with those types of lenders, we're seeing their turnaround times blow out 15 to 20 business days for pre-approvals, for purchases. To be honest, it doesn't matter what it is. Once it's in that bank system, they can't do anything until you've ticked off those days. We're seeing some of the bigger banks, since COVID, when we did have that lending explosion, they did hire a lot of people. They kept them on. Their turnaround times have remained fairly steady since they got over that sort of peak of lending. But definitely there's a lender with a niche, especially a niche that's targeted to investors. We are seeing such a influx of investor inquiries into our business. We're only one business out of we're four brokers out of 18,000 brokers. I can only imagine how much more is happening out there. And I've actually got a question for you, Aaron. So one of my clients came to me, and it's something fairly common that we're seeing where in their 40s, they've paid off their home, they've done the right thing, they've smashed their home loan down. They've got a lot of equity, and now they're just starting to get into the investor sort of market. They're doing their research. They're talking to buyers agents. They want to start investing, but they're a little bit nervous about using the equity in their home. What would you say to someone who's maybe a little bit nervous about, tapping back into their house, to their home where they live?
Yeah. Thanks very much. We get this question consistently from people that are paying down their home loan or have huge amount of equity there, and they just don't want to touch the equity in my home. And my first question is why? And generally, it's come down to a horror story. I just don't want to. I just want to leave my home out of the equation, and it's probably got to do with the bad rap that cross securitization or cross collateralization has. So, if it's a new term to you, it generally means that the bank's going to take the home and then use that and link it to the next investment property, which generally has its own issues. When you go to sell, you got to uncross the debt. I've got to tell you right now, we've been doing this, guys, 8 years as a Atelier Wealth. I've cross-securitized one investment property just because they want to get the lowest rates. That was all it was. They wanted to buy one investment property, no more. And we did that purely to get the lowest rates, and we could uncross the properties anyway. To me, I'm like, there's no lazier way to structure a loan than to cross-securitize properties. We keep them all independent and separately. So I'll go back and answer the question very easily. I don't want to use the equity in my home to buy an investment property. So what are you going to do? Use cash? That's absurd. You're going to use cash to go and buy a property that has the tax benefits attached to it. Sometimes I can't talk people out of this, but I can talk them a way around their fears. And the fears generally come from, are we going to lose our home if something happens to this investment property? No. So that's one part. The next part really is around this fear that they've got to pay down the mortgage before they can go off and buy an investment property, right? It's like, no, we can still run this concurrently. You can still pay down your home loan actively why you go off and buy an investment property. Because here's the thing, you're going to wait for the next 5-10 years before you start paying down your home, or in that next 5 to 10 years, we put that equity to work and you go and buy investment properties that increase over the next 5 to 10 years. Potentially you could sell those down, extinguish your home loan. You haven't had to work as hard to pay off your home as well. So I really put it back out to someone, or if you've heard this from someone that says, I don't use the equity in my own home, we have to challenge that, because it's lazy equity. That's a gold mine that should be put to work, is my opinion. Bernie, what are your thoughts?
Yeah, I agree. And I think when I first started as a broker, I actually held that view. I was like, no, I should pay down my home first. So I was one of those people. But seeing now, having been in this industry now for 8+ years, the power of property, and for you to have, if we had bought even more properties back then, where we would have been 8 years on would have been a completely different trajectory. And the power of those investment properties, one, growing in capital growth, but two, in rental income over a period of time. If you then realize that 10-year mark, 15-year mark, whatever your investing time frame is, if you can sell off 1, 2, however many, pay off the home loan debt, you're sweet. You've got that flexibility. You've got that ability to make your own decisions. Do I want to leave work, look after the kids? Do I want to travel? Whatever it is. So this one is a big one. It took me a long time to get my head around, but one that I fully endorse.
Yeah, and I sort of understand the I guess the cautious side of things. I don't want to lose my house. You know, we don't all have the same framework from where our financial decisions come from. You know, you might have come from a scarcity household where there wasn't that much money around. You've probably gone out and bought your first home. You know, you've raised your kids in there, and all you're thinking is, this is my oasis. This is my castle. I do not want to lose this, and risking it for an investment property, I don't even want to think about it. I guess that's letting emotions drive a decision and not logic or some facts. And speaking to Aaron's point about not cross-securitizing a property, well, if you drew equity from your owner-occupied property to buy an investment, we would keep those two properties completely separate. When you go and buy that investment, whatever happens to that property in the end is linked to the loan that's against that property, not linked to your home. So at any point, I guess, if you were getting nervous, if the property wasn't performing as you wanted, you could always sell it. Your owner-occupied property would be left untouched. You might have a little bit more debt, sure. But this is worst case scenario thinking, guys. In reality, over a 5 to 10 year period, property goes up in Australia in most markets, you know, except if you buy next to a mine.
That's what we see. Service apartments.
Yeah, service apartments, studio apartments. All right, there are outliers here, guys, but generally speaking, if you are buying a really good asset, a good quality asset, and that's what we really focus on here at Atelier Wealth. We're buying good quality assets in high demand areas, assets with really strong rental yields, assets with capital growth potential. That's what we're talking about here. We're not talking about going and risking it on Bitcoin. It's not risking it on black at the casino. This is a tried and true asset. If you're engaging a buyer's agent, they're going to help you, give you even more knowledge to go and buy a really good asset as well. So, yeah, I mean, I hear the fears. I get that. But don't let the fears and really don't let emotions dictate how you invest, because it's not really a good way to proceed.
Yeah. I think it's spot on that you touch on the emotions, because here's what it is, mate. It's money, right? And it's fear of the unknown, for example. So, yeah, people that say don't play any emotions in these decisions, I'm like, that's BS, because we will always think probably worst case scenario. We'll always act more on fear than we will on the benefits or the upside as well. So I think it's good. Be cautious, be nervous, always ask the questions. But if that's going to stop you from taking action, then you've got to check that at the door somewhere and go, I need it. And I say this time and time again, the property market rewards action takers and decision makers. No one made money on property through COVID that didn't have some level of debt. So say what you want about it, but to me, I'm like, yeah, you've got to be willing to pull the trigger at some point. I'm going to shoot around, because this is a question that we will all get from our own clients as well. Should I pay principal and interest on my investment property loans? Bernie?
Thanks, ACD. So this is a statement or a question I had from a client last week, and I thought it was really topical. So I just wanted to give you a few scenarios about why you would and why you wouldn't,
Sure.
because it's not always black and white. So we all know investment properties, interest only is ideal, tax deductible, and also for cash flow purposes, right? We channel that payment that would have gone on the principal of the investment property onto the owner occupied property. But are there circumstances where having principal and interest repayments would be beneficial? And the answer is yes. So the situation was actually where the clients, they had no owner occupied debt.
Yeah.
So had no owner occupied debt, they can pay principal and interest if they want to own that asset, unless they've got other requirements for the funds. And then the other one from me is principal and interest can be used if you need to extend out your borrowing. So when we go interest only for 5 years, in the bank's calculators, our repayments are calculated at not 30 years, but 25 years. So we have to pay back a property quicker versus if it's principal and interest for 30 years, you've got an extra 5 years to pay that. So it actually might help you get a little bit more borrowing power.
Yeah, I agree with those reasons, Bernie. I think with principal and interest, it's one that I get a lot because I deal with a lot of first-time buyers, a lot of first-time investors, and it's probably one that I've had to think about. It really will depend on your situation, but we speak to a lot of buyers agents. There seems to be a strategy. There's a strategy that people will take where they are rent vesting. Yep. So the goal is to accumulate, 5 properties in the first 10 years of their property cycle, sell off a portion of that portfolio, and then go and buy an owner-occupied property. That's the way to get into some of these more advanced markets like Sydney or Melbourne or now even Brisbane, if you don't have that initial capital from parents or some type of assistance or a really, really good job. So you're using the property market properties and investment properties as a stepping stone to get into some of these more advanced markets. Now, in these circumstances, like Bernadette said, you've got no owner-occupied debt. So what's wrong with paying down the principal of an investment property that you're eventually going to sell? And what's the benefit of paying principal and interest in that circumstance is you actually get a better interest rate. So your interest rate's going to be lower. You're going to pay less interest. You're going to be paying down the loan. You're going to have capital growth on a property as well. When you go to sell it, you're going to be in a better position. And probably the big one here is like anyone can say, yeah, I can still go interest only and just put it into the offset. Sure, you can also do that. Pay a high interest rate. It's only going to be a couple of basis points higher. But do you also have the strength, the money mindset to actually put it in the offset? Because we're only talking about $100, $200 difference, $300 a month, depending on the loan size. It's not that much, and it can easily get lost. You can easily spend that money. So if you are the type of person to be a little bit loose with cash, paying principal and interest is a way of forcing you to save. And if it's on an investment property, you don't have any owner-occupied debt, it makes a lot of sense.
Perfect. Yeah, you guys covered most of what there is to cover off. The things I would add, I think Damien just mentioned, offset. If your repayments are interest only, any spare funds you have, you won't make repayments on what's in your offset account or the difference. If it's P&I, you'll still make the full repayments every month, but a higher proportion of that will go to the principal. Now, P&I, some instances I've seen people go P&I is if they're not in an aggressive acquisition phase and they can comfortably service this investment property, they'll just go P&I and pay the loan down because they can afford to.
Yeah, thanks very much, Nate. I appreciate that. And not too much. My views aren't too different. I'd be big interest only if you can. But if you need to unlock borrowing capacity, switch it to P&I. So my suggestion to every client is start interest only. You can start there and you can easily go to P&I. It's a flick of a pen on a switching form versus if you start at principal and interest, you can't just easily go across to interest only. You've actually got to reapply the loan. So if you're thinking about it, you want to scratch the itch, start interest only, get used to paying the principal repayment on top of that. Try that for a month or two, see how you go. You probably won't even feel the difference to Damien's point because it's marginal cash flow at the moment. Back when we started, it was significant, but those rates were very, very different and the repayments are very, very different. Whereas now I feel like Gap's really tightened up as well. So that's why investors were always going IO, or interest only. But now this notion to principal and interest does generally help from a borrowing capacity perspective, especially that 5-year interest only period as well. One last point. July is around the corner. This is exciting for Bernie, being an accountant in your past life, and we've talked a lot about the upcoming tax cuts that are coming into play. Bernie, what are your thoughts for anyone that's staring at the barrel of working out how much extra they're going to get? What's your advice to them?
Thanks, ACD. Yes, so 1st of July, the tax cuts coming to every Australian household, and my words of wisdom are, please do not plan on how you're going to spend it. Instead, please plan on how you're going to invest it.
Yeah, sure.
He's already spent the money. He has already spent the money.
I have already got my budget ready for the new tax cuts, or the new tax system, the tax rates. But yeah, I think Bernadette's right. I mean, if you are doing it tough, rates are high, it's going to be a bit of a reprieve. So you may get some of those creature comforts back in life. Yeah, you might get to go to the movies, take the kids out. That's what it's there for, to give us a little bit of a cost of living relief. The other one is the HEX rebates that are coming out. So they're changing the way they've calculated how they increase HEX from the CPI, Consumer Price Index, to the WPI, the Wage Price Index. So we're going to see a lot of the students get rebates from the CPI increase that they got from 2023, I believe. So expect that to come through. Yep, invest it. If you're doing it tough, go and have some fun.
Yeah, I'd say along with what Bernie said, plan on how you're going to invest it. Borrowing capacity should go up, more take-home pay. So speak to your broker if you're looking to get into the market.
Now, you've been very quick to pass over the mic, but we were just talking about HEX a minute ago. I understand you bloody paid off your HEX, didn't you, Nate?
Yes, I did. Big chunk of change going out of my savings account. But yeah, I had to do it before I got indexed again. But yeah.
Because if you didn't hear our last Q&A, we did speak about the impact that HEX has on borrowing capacity. Nate's just mentioned that he's looking to buy. He did his own numbers and realised that, paying out HEX was going to free up more borrowing capacity as well, and he had the cash to do it. So, mate, well done to you. And I'm looking forward to see what your purchase looks like in the future as well. But yeah, for me, these tax cuts, the sugar hit will be to spend it. And whereas I feel like, mate, we've gone through these tough times, we've got used to it. Grind through it would be my suggestion. If you are struggling with cash flow and you're a property investor, and that means you've got one property or more, we've spoken about PAYG tax variations as well. So if you need that cash flow back into your back pocket, don't wait for July. Speak to us, speak to your accountant, for example, find out how to do a PAYG variation on your investment properties. That again can be just that extra little hit of cash flow that you're looking for to help free up a bit more income, that you're not feeling the pain of holding those investment properties as well.
And just a quick little fun bit, just when you said property investor, one property or more, I had a client, I asked him about his initial fact-finding call, and I asked him, tell me about your portfolio, your property portfolio. And he goes, I don't have a portfolio just yet. One owner-occupied, one investment property.
There you go.
I would say it's a portfolio.
Absolutely.
What would you say, Aaron, the definition of a property portfolio is? Is it one owner-occ, or do you need a couple?
A portfolio, I mean, if you had a share portfolio, you had ownership of like CBA shares, a share portfolio. I think the other part to me is it's more the mindset. That's what I take away from that. And you know what he said? I don't have a portfolio yet. I'm like, these are the type of people that we love talking to, because they're thinking big and they're going, it's going to happen. It's just not happening to me right now.
And for it to be a portfolio, we're talking 5-10 properties in this client's mind.
And that's what people think. It's like, actually, we've had heaps of clients that have bought 3, 4, 5 banging properties. They don't need 10 because they don't want the headache, but they've bought quality, say, over quantity. And we're big on that as well. So to me, it's like when we spoke about atomic habits. You can choose to see yourself as an investor, and you do the things that investors do, which means I hang around people. I know my borrowing capacity. I know what these land tax issues are going to be. I'm going to pick the brain of more successful people versus, I think I'll buy a few more properties. And then that's the people that kind of just squirrel away, and they had hopes and dreams, but they faded because, managing 3 properties with rental property managers got a bit tough for them. But yeah, I'd say to your point, mate, we love when people show up like that, because we know we've got to match that energy going, I see where you're trying to get to, mate, let's put the foot on the accelerator to help you get there as well.
So on that, can I ask the question then for everyone in the room, what is a property portfolio to you? If you get to this many properties, how many or maybe as well, what are you working towards?
More. I'm always working towards more. So for me, look, I definitely want a portfolio that at some point can supplement our income. I'm not looking to replace my income. I think that's the difference. I do enjoy what we do. I think it gives us a pretty good lifestyle. Not the fact that I can spend a lot of time not working, but I think it can give us a way to springboard our wealth into property. So that's how I look at it. So to me, I want to build a portfolio that can supplement our income, so I could probably choose to work a little bit less and less intense. And it's going to give me choices in and around. I think I might have said it before. My ideal life plan is to live in overseas cities for a few months of the year at some point in the future with the kids. That's Italy, that's Bali, it's New York, and some really awesome. I think that's what property can afford me to do it in the future.
Yeah, for me, I think what Aaron said is, financial freedom is the ultimate goal when you're investing in property. Me personally, I'm just getting started on my journey. I tend to just go with the flow. I'm just doing what I can at the moment. Hope to, eventually acquire even more and get to that point of financial freedom.
Nice.
My goal would be to have an income source where I don't have to work. I think it'd probably be to supplement my super. So super's ticking away. I'm pretty happy with how my portfolio is growing. I think everyone is at the moment. I think everyone's getting 10, 12% growth. We're not doing too much, but you feel pretty good when you look at your annual statement. Look at your annual statement coming up in 1 July. But I think it's about getting assets that are income producing, because I've only just recently bought my first home, and the realization that this home just costs me money. There's nothing that it's giving back to me until I sell it. So living there is going to continue to cost me money. If I can get an investment property, 2, 3, 4, say the amount you need, that's going to, after I've paid off the loan, start to give me income. That's really what I want. I want an income producing assets. I want to probably to supplement my rates and water bills, to be honest. But when I do retire, there's going to be a point where you need to retire. You'll have your super. Hopefully you'll have a pretty good chunk of super. But having some investment properties as well to supplement that income for as long as you can, and then also pass it on to families. Pass it on to your kids, your nieces, your nephews, whoever you do decide to pass on your wealth to, and give that next generation the leg up. Because I think we all can agree, getting a leg up is, especially in Australia in the property market, is nearly essential unless you work really, really hard. And I think everyone in this room is working really, really, really hard. There's not too much of the leg ups that we are getting, apart from a couple of guarantor loans, thanks mum and dad. But if you can give that to your child, how much joy will you get from that? So I think that's what I'm working towards.
Did you answer your question, Bernie?
I didn't answer. I think definitely feeling itchy to buy another one this year, that's for sure. And then, definitely more. Not from a point of greed. Definitely not, and not to say, oh, hey, this is my number, but definitely like the boys have said, that financial freedom, that supplementive income, and just knowing that while I sleep, that those properties are earning for me. I
think we were having a chat just over lunch, and we're talking about how much the Woolies CEO made, right? Like, he brings extreme value. We got no qualms with that. But I'm like, you could do that with a property portfolio and not have to work as insanely hard as some of the CEOs do. We see it. Don't we? Portfolios. Clients are doing some exceptional heavy lifting on their portfolios that don't have to fly around the country all hours working, non-stop, trading their time for money. Instead, they've got assets that are producing income while they sleep. I think that's where I want to leave it today and just go, look, if that sounds like you, we are offering investors of 2 camps a way to help them out. So if you're a new investor and you want to work through a property plan with us, i.e. how much can I borrow, how much can I scale my portfolio, awesome, reach out to us. If you're an experienced investor and we haven't worked with you and you want to pop the hood on your portfolio, how much equity am I leaving here? Can I get valuations done? Can I buy my next property, whether that's in my personal name, through a trust, through self-managed super funds, for example? reach out to us and let's find a way to supercharge your property portfolio, because there's nothing worse than equity and borrowing capacity going to waste. I hope you've loved this episode. Again, please just reach out with those messages. We're loving it. And until next time, take care.